Hello guys, welcome back. In this video we are taking a look at Target, which today had a bad day. It's down 2.3% for the day, and things happened, and we're gonna examine what exactly happened with Target today. And I will show you how you can actually use the financial statements to kind of potentially foresee what happened today, although you can never know for sure, but there are some telling signs that can give you some ideas about something that could potentially go wrong earlier before it actually does. So if we take a look at the stock news here, you will see that Target steps to reduce inventory glut are correct, but are a few weeks late. Target to return soon to strong profits. Target's high inventory warning is just getting in front of the problem. So something happened here, and I have opened up, you will see all sorts of articles. I've opened up this one. Target is bracing for a profit hit pretty much. And you will see that Target takes steps to dump excess pandemic era inventory, including more markdowns for customers. And of course, we did know that we were during a pandemic, and it looks like Target actually got more inventory that it could actually sell. And now they seem to have excess of that. And excess inventory can be problematic, especially for things that get depreciated. But you will see here what happened. Target announced a plan to offload excess inventory and cut its Q2 profit margin forecast because of that, of course. And so the stock dipped as much as 4%, actually even more than 4% right now, it's better. But Target said it will put more items on sale and cancel orders to clear space for in-demand products, which means that they could have revenue, but overall they will have less net sales because they will have to add some sales here. And so it means that they are going to be making less on the product that they are selling. So what happened exactly here? Get ready for more sales at Target is what the article points out here. And so the retailer announced on Tuesday that it's taking steps to deal with excess inventory, including some markdowns, clearing out extra products and things of that sort. And they did say that they have been monitoring consumer behavior amid the current economic climate, which is interesting, and opted to act now in order to remain nimble. While these decisions will result in additional costs in the second quarter, we're confident this rapid response will pay off pretty much, resulting in improved profitability in the second half of the year. So Target plans to focus on merchandise that remains popular, of course, with customers. And it warned during its fiscal first quarter earnings in May that it was dealing with a glut of inventory in bulky categories like kitchen appliances, TVs, and outdoor furniture. So people haven't been buying that much of those things. And it kind of makes sense. I mean, during the pandemic, a lot of people actually stayed home and probably didn't really care about buying new appliances, TVs, and things of that sort. And so they definitely have more inventory than they can actually sell right now, it looks like. And they seem to have ordered more than they could actually sell, which is interesting as well. Okay, so the thing that is interesting here is that some of those discounts likely won't go into effect until later this year, the discounts that Target is aiming to happen, given lingering supply chain challenges for several retailers, but others are already clearing the way for in-demand goods. So it looks like they are setting up some sales in order to pretty much get rid of that extra inventory. We'll see if they manage to do that. But the stock took a hit, and after that hit, we can kind of see whether it makes any sense to maybe even buy the stock right now. I mean, right now it's sitting at $156, it looks like, 42% down from its highest in the year, really. And again, we have talked about the company. You will see like the 5-year chart here. It's been going down a bit lately. But the P ratio of that company is 13 and the price to free cash flow ratio is 14.2. Now, this is obviously a discount store, Target. And so generally speaking, it's a good idea to have maybe a little bit of a discount store in your portfolio. Some discount stores like Walmart or Target is an interesting idea, and it kind of helps potentially if there's going to be an inflationary environment and a recession potentially, because these kinds of companies tend to pay some fixed dividends or some dividends that are actually pretty safe for the most part. and they can give you a little bit of income without having the worry that they will go down massively. For the most part, these types of companies don't go down that much. Even if there is a recession, everything goes down in a recession, but these companies tend to handle this price movement, this downwards price movement, in a better manner overall. So maybe this is a more secure play, really. Now, we would obviously like to get this at an even lower PE and price to free cash flow ratio, because it's a retailer, and it's a safe retailer. It's sort of like a safe company, a safe stock. These kinds of stocks, these kinds of businesses that do not grow too much and are like retailers with a lot of assets, like buildings and things of that sort, inventory, which means also lower margins typically. They tend to be selling at lower multiples, and so the lower the better. Now, this is not terrible, of course, but it may actually even be better to look for even lower multiples, especially in this current market situation where a lot of things are down. So yeah, that's definitely worthwhile noting. Now, you will see that the company has been buying back shares, which we obviously love to see. We want our companies to be buying back shares because now our shares are worth more. Company seems to be having a little bit of debt here. We have again talked about this one, but it's interesting to see that their key metrics are all positive, even though some haven't been growing that much. They have still been growing. Again, this is a behemoth of a company. It's a retailer, low margins, and generally speaking, the revenue growth won't be amazing. But the dividend yield is 2.3%, and the payout ratio is 32% in terms of the free cash flow. And if we take a look at the dividends chart here, you will see that it has been increasing and increasing. So this may be a nice play for a more like a safety play here that will make you some income as we are entering this inflationary period in the economy. And the last thing that I kind of want to see here, oops, actually that's wrong. I clicked the wrong link here. So you will see that the revenues, of course, have been growing, and net income has been growing too. We have talked about this, but what I wanted to focus on a little bit is the working capital here. And you can kind of see the change in working capital for every year over here. And you will see that in fiscal year 2021, the company spent quite some money here buying actually assets that they are going to be using for their business, really. Like, for example, inventory over here, like minus 3.2 billion of extra inventory is what they bought back in 2021. And so this means that they spent cash in order to equip themselves with extra product, pretty much. And the same you can kind of see here on the quarterly when we're getting closer to 2022. You will see that changes in working capital and inventory tend to be negative for the most part, in the billions. Again, this means that the company actually spent money to get equipped for the most part, and now its current assets are more than its current liabilities. So this is interesting to notice, because if you have seen this thing, and if you have seen the company actually piling up, stocking up on inventory as we're having the pandemic, you may be thinking, okay, why are they stocking up so much? Are they expecting so many sales? And would you think that they would be able to sell all this inventory? I mean, this is food for thought, of course. Before the issue happened, really, you couldn't really know for sure. But it's definitely worthwhile noting that you could have gotten a hint here based on the inventory that the company bought, and now things have happened already for this company, for Target, but you may be looking at other companies, other retailers of that sort, seeing this kind of excess inventory potentially, and thinking that, okay, if the company bought 3 times its inventory from the previous year, maybe something is wrong here. It's almost at 2.5 or something. So yeah, you can look at these differences and kind of tell here that something may be a little bit off. Okay, and the last thing, I'm gonna go quickly through the stock evaluation tool. Again, we have done this before. I will just try to see what will happen if the company grows very little as an exercise, because yeah, I have made videos in the past about Target, even one rather lately. But let's examine what happens if the company grows just 1%, 2%, and 3%, and they have low margins like 3, 4, and 5 here, which will be low if that happens compared to the previous years. And free cash flow margin over here, again, it's about a little bit all over the place, really. So I will go somewhere in between. Let's just go 80, 90, and 100. and an annual return of 13% over here. And if we hit calculate, you will see that it's only our high estimates here that are green, but remember that these high estimates are basically almost like medium estimates. Now the thing is, the current price is 156 over here, and our high is at 172, yet I would definitely want to buy it at a lower price. Again, I've told you that before, that this company is not bad at all for adding to your portfolio. It pays a nice dividend, but it may be a little bit more expensive for a retailer of this sort. Now, what you may want to do is kind of compare Target, Walmart, these kinds of companies, and see which ones actually make the most sense. Maybe Target actually does make the most sense based on the financials. It kind of helps to compare all these companies together just to see which one could be a potentially better buy if you want to be adding a discount store in your portfolio, which could be a good idea. But this one is definitely some company, a company to be having in your shortlist for sure. Maybe watch for it. Maybe it will go down a little bit more, especially since this kind of news came out. And if you get it at a little bit of a better price, then it may be an even better opportunity here, and kind of give you more effective dividend yield actually as it goes down. So interesting company, definitely some company to think about. But I would definitely urge you to compare it to its competitors and see whether you can get even better prices, really. Thanks for watching. I hope you enjoyed the video. Remember to leave a like and subscribe, and I'll see you in the next one, guys. Thanks for watching again. Bye bye.